Welcome back to the channel. My name is Brahim and I'm going to talk about one thing in particular, Jim Cramer. Now, he's the host of that program, Mad Money, which is like on COINBASE, I believe, and he just talks about stocks on there and what he thinks is going to happen with the companies, looking at earning reports, etc, etc. Now, this guy, a lot of people don't trust him for obvious reasons, but I want you to know what you're really not supposed to trust. So after I'm done speaking, there's going to be 4 videos. I want you to watch all of them and you'll understand. He brags about market manipulation. He brags about short selling, about putting fake news articles, pushing agendas. He brags about this. He doesn't ethically invest to see a company do well. He just manipulates prices and other things. But don't take it from my word. Watch these video clips I will play after this.
This is James Altucher with TheStreet.com TV, and I'm here with Jim Cramer, and we're going to talk about careers in the investment business.
Oh, good.
So, Jim, let's say there's the clone Jim Cramer who's just graduating college today, 2007. What's he going to do? Is it hedge fund, mutual fund, trade on his own, bank.com business?
I happen to think that the classic method of training is to go to one of the great investment houses, where they'll rotate you through all different divisions, and then you end up in the analyst division. And in the analyst division, they pay you to learn how to analyze securities. Now, I went into sales and trading, but I spent my time, I was part of my group, we had different groups. There was a guy in my group who was, there's three people. One guy was the schmoozer, so to speak. He brought in new clients. One guy was the executor, and I was the research guy. So I spent all my time down there and in research. And what I would tell you is that the classic training is what the Steve Cohens of the world with the great hedge funds want. They don't want gut, and they don't want you to say, listen, I've come up with a new way to think. They want to have that background. So that's where I go.
Well, let me ask you this, though. Let's say you didn't go to one of the top colleges, or you didn't have 1,500 on your SATs. You can't get the job at Goldman or Morgan or CSFB. So what do you do? What do you do
then? I think you have to go the other route, and you have to go to a hedge fund, and you say, okay, look, let me get you coffee. Let me get you on a trading desk. Now, I mean, that route is by, and I'm not supposed to talk about it because she hates it, but my wife, Karen, and again, I give the caveat that, oh God, she hates I talk about this, but she caught on from the trading desk from a clerical position because she didn't have that background. That's a longer way. It's a hard knocks way. If you have great conviction, it can happen, but you have to go in with the attitude that, look, I am really smart. I am perfectly willing to give you 2 years of my life in just a low-level job to let me, at the moment, and this is the example of the guy who's the understudy in Broadway, or equivalent of the guy who's the number 3 depth chart in football. It's like the first guy gets hurt, the second guy gets hurt, suddenly you're on the desk. More of happenstance than I like. And then one other way is if you go to a college, and it's a good college, I mean any college, if you can go to the alumni network of maybe someone, like one of the things that I there was a school that I've recruited out of many times, which is Monmouth. I recruited out there because the guy who ran the department at Goldman was from Monmouth, and he was great. Obviously, I mean these places, you go to great school, people go to different schools, and you get you go to Monmouth, and you go into you write the guys who are the powerful alums, and they'll give you interviews. So I mean, there's a lot of ways to skin the cat. Obviously, the most direct way is to catch on at one of the big firms.
Now, let's say you're at one of these banks, and now you don't necessarily want to work at one of the big hedge funds now. Would you start a hedge fund?
I was just talking with someone who's in an analogous position. He happened to have worked as a research analyst for one of the best hedge funds, and he's now decided he wants to go out on his own. I started with I had $200,000 in the bank, and I didn't get paid my first year, so I ended up with $100,000. I had to borrow $10,000 from my dad just to make my ends meet. But you know what? I had $5 million under management, and then I turned that into 10, and then I turned that into 50, and then 100 in 2 years. 2 years. And I would emphasize that if you have any money in the bank, go do it yourself, and go build that record. And if you do it, and you're confident, you will get money.
Well, let's think about that for a second. Let's say you're going from 5 to 10 to 50 to 100, and there's a lot of other guys. There's 9,000 hedge funds out there right now. what percentage of your time do you think you're going to spend marketing as opposed to research and trading?
Well, I think that the answer is 50-50. And if you're not a marketer, one of the reasons that I liked the classic training I had at Goldman was also sales training. So I was able to recognize sales training is really a matter of not getting down on yourself when you don't get the money. But I would tell you that that if you go in with the approach that it's 50-50 and you're able to spend more time doing stocks, that's great. But James, let's back up for a second. It's really, everybody thinks it's for everybody, and they see the money being made, and it's really sensational. I mean, I could go back to it, and I could make a lot of money. But I had a unique skill set in that I didn't sleep a lot, and I really was curious about the market, and had really good discipline and good training. Most people, it's not right for them. Now, there's also a whole cohort of people who basically are faking it. They're going and raising money, and they're saying, listen, I can generate a little above average return. I mean, you go into hedge fund and make it rich. And a lot of people are going to get blown out. I left Goldman at the same time as 4 other guys, okay? And 3 of them were back at Goldman within the next year. And I was out there on my own. But I was out there on my own because I didn't want to work for anybody and because I had unique stock picking talents. Now, it's very interesting, by the way. I get a lot of criticism in email and stuff from people saying, you don't know what you're talking about. And sometimes I usually just say thank you. But there was another period where I would pick fights, and I would say, listen, you have no idea what you're talking about. I mean, 1987, I was in cash for the crowd, really good. You're either good or not is what I'm saying. And, that's okay. The hedge fund world is the NBA. And there's a lot of people who want to be in the NBA, and not everybody gets in the NBA, Major League Baseball. And that's okay. But you certainly want to take a run at it. You certainly want to try to be in the NBA.
Well, what's interesting also, I think it's not just stock picking, but also how do you deal with that stress of first losing somebody else's money?
I was down 9.9% after the first month. I had a 10% provision, which is I had to give you the money back down 10. I'm down 9.9. I go into I was down 9, and it took me 9/10 to liquidate. And I just sat there and I said, okay, now I got to wait for my pitch because I'm teetering. I waited. Finally, I got the call that Data Gem was doing better than expected, and I got in at 20. It went to 23, and then then the next thing I know, I bought Acme, and that was rumored to get a takeover bid, so I blew that out, and then and then I had the Phelps Dodge and Georgia Pacific, and what I did was recover, but most people can't, and what people don't understand that it's a very solo business. Again, I keep coming back to that it's not for everybody, but you want to give it a try and see whether you have the right temperament.
Well, thanks a lot, Jim. And I also want to add, actually, if you want to read more about Jim's startup, I think in the book Confessions of a Street Addict, there's 3 great chapters. There's the 3 best chapters, really, in almost all these investment books. There's your startup chapter. There's the chapter about, I guess, October 1998.
When I blew it.
And then there's the chapter about TheStreet.com, which was very interesting. The startup of an entrepreneurial phase.
One of the things that I have been, that I pride myself in is really revealing everything I did wrong. And the book is replete with probably like 100 things I did wrong.
Well, it was fascinating stuff. Well, thanks again, and thanks.
You.
This is the James Altucher at TheStreet.com TV.
Hi, this is Jim Cramer, expanded edition of Wall Street Confidential, a message to people about how to short. When I see what's going on with Amazon, and when I see what's going on with Whirlpool, with F5, it's very clear that what people are doing is they have a thesis. And the thesis is that there is a problem with the stock, and the problem will not be solved this quarter because there's nothing that's a catalyst. F5, a lot of people had called me and emailed me saying that I ought to go out negative tonight's sell block on Mad Money on F5 because it had been acting doggy. Because there's no way that a traffic coordinator on the web could continue to grow. That's not a good reason to short. Amazon, I mistakenly pointed out on TV that because it was up 70% since August, maybe it was time to get off. Again, not a reason to sell. A Whirlpool, where people were going wrong there is the previous quarter was not that good. Now, in all 3 cases, the guidance from these companies from the previous quarter was not good. All 3 cases, short sellers felt that therefore this quarter had to be bad. Another classic. Why would you ever trust these companies' guidance? They didn't know how to guide going into the quarter. Why would we trust their guidance going out? They were sandbagged. Now, but let's talk about the way you short. There was, if you really believed that Amazon was going to go down, if you really believed it, you didn't need to see it this quarter. You should not have been using common. Same with Whirlpool. Whirlpool, the 90 strike was expensive. That is a tell that would have been good. I would have bought the Whirlpool 90 puts for a couple of bucks, or maybe the 85 puts if you thought it was going to fall apart. Amazon, the 40 puts would have been right. F5, that stock is up so monstrous. 2 strikes down would have been right. What I am urging you to do, if you're in the game and you're shorting, whether you're professional or an amateur, do not use common stock. It doesn't work. If you are addicted to shorting common stock, go and buy the Whirlpool 85 calls and short common against it. So if it drops below 85, it's a risk reward. Sometimes it's cheaper than the put. You cannot use, in this kind of blow off to the upside, regular common stock to short. I wanted to take this moment to say that to you because I've had 3 friends who've been put out of business in the last couple of days. Why? They didn't use puts. This is the safe zone. If you're going to short, you can only do it with puts. You cannot do it with common.
Welcome to Wall Street Confidential. I'm Aaron Task here again with Jim Cramer. And Jim, a little weakness early today. We've gotten a rebound here. Do you think this is going to continue?
This is perfect. This is just what I've been calling for in real money. You needed the down opening to get rid of the last sellers. Texas Instruments gives you a real good umbrella to take tech up. This is going to last 3-4 days. The
Even
tech
though
rally.
they said the first quarter is not looking so good.
No,
it doesn't matter.
It was irrelevant. They could have said things are horrible. We just had to get it out of the way. The fact is that they did say that the end of the year could be good, which was enough to be able to get Merrill to upgrade. These are predictable rallies. When you have a very bad options hangover that finishes right near the end of the day, which is what happened, the market was able to rally, and you have a big bad event like Texas Instruments, you get it through, then you're going to have several day rally. Shorts definitely caught leaning the wrong way into this rally, both on the home builders and on the semis.
I'm going to get to the home builders in a second, but in terms of technology, you talk about Alcatel, Lucent, more bad news from them, but that's actually going to help the tech rally because it's good for Cisco.
Right. We don't care about Tel Labs. We don't care about Alcatel. We don't care about Nortel. These are companies that the media focuses on as if they're important, which always makes me laugh. Motorola is important only in terms of its breaking down, so that Cisco has more of a leg up.
Okay.
Cisco and Apple are the only 2 tech stocks right here that I'm not going to be cynical about and suggest that you just buy for to bash the shorts. I mean, those actually have long stories.
Right. You mentioned Apple. Again, news today, Steve Jobs being probed by the regulators about the backdating. You still think that is a non-issue?
That's a charade. They have to maintain the charade. There's been no official guy appointed internally to throw him under the bus, and the board stands behind him. But if you were the feds, you obviously have to do this because it's in the papers every day. So let's everybody go through the motions and have a good time.
Somebody asked me about this, so I'll put it to you. If you were some young up-and-coming prosecutor, wouldn't you want to put Steve Jobs' notch on your belt like Elliot Spitzer did with Dick Grasso and others, or is he too big for the feds to go after?
I think that that office is notoriously weak. I don't think that anyone Elliot was the exception because he was a billionaire, so he didn't have to worry about the interests. Most U.S. attorneys have to worry about the interests, so it's usually a pretty honest group of people, but you probably don't want to go against a guy who could really, if you had a political career ahead, really hurt you in the fundraise.
Okay. Moving back to the market at hand today, you mentioned the housing market. D.R. Horton, down from a year ago, but better than expected. I want to ask you about the Goldman.
It was the Goldman call. I mean,
right.
Goldman had a sell in the group, which was clearly wrong since September.
Okay.
So the guy had to find a time to be able to change his view. He's able to do it by saying, look, Lennar didn't go down on the bad quarter. Pulte didn't go down. Gets lucky on the D.R. Horton. But this is a group that the shorts are still fighting. Shorts aided by the media. And you can't stay shorted anymore just because the momentum of the buyers, not the momentum of the companies. Companies are awful. The momentum of the buyers is too great. Right. There's really no good news other than perhaps Rylan, which is a Washington D.C. builder, but there's no real reason for the stocks to go up, which often is a great thing to buy because you have no real data points that are perceived as negative. One of the things I think that people, and again in Wall Street Confidential, one of the things you have to recognize is that you have to understand the temper of the market. You have a negative, and the stock goes up. Well, you're home free.
Right.
You're home free. That's what happened to the airline stocks about 18 months ago.
Right, because the Goldman analyst, Chris Morris, I believe his name is, right, there's an inadequate risk reward to being short the home builder, which has been the case for 6 months.
I think that was a good recognition that the stocks don't trade with the fundamentals, and I think that's right. The same reason that American Standard goes up every day, Masco goes up every day. I mean, these stocks, Black & Decker's probably a buy here. They've already pre-announced. Right,
interesting. Another call out today, I think you disagree with the Bear Stearns call on oil services, which are rallying in here today.
Well, what he's doing is he's deciding that Schlumberger doesn't know what it's talking about. Now, there are domestic drillers and there are international drillers. I don't want to be long any domestic driller because on the Schlumberger call, Canada's really bad. I mean, Canada's where all the weaknesses, not even the United States, it's Canada. And you want to, if you're levered to Canada, which is neighbors, which is a lot, or to domestic, like a Prideco, it's pretty obvious who's domestic. You don't want to be there. I'm focused on Schlumberger. I'm focused on Transocean, which is the cheapest in the group, Global Santa Fe, and I'm still betting that Halliburton makes a big international acquisition to save it.
Right. Now, is Canada bad because of the tax changes that
which one
coming down the pike? Is Canada bad because they said the income trust may be taxable?
Yes, I think that's cut back spending. Also, it's natural gas, and natural gas is, even though the price of natural gas hasn't fallen at all, is not perceived to be where the growth is. You don't want to be levered to natural gas if you're drilling.
Okay, and
by the way, that's again the stocks. The companies themselves don't mind making good money in natural gas, but we care about the stocks on the show, and those stocks are bad.
Right. In terms of caring about the stocks, I want to ask you about the State of the Union tonight. A lot of focus on the alternative energy plays. You were about Hoku Scientific this morning. You're bullish on that name, which is more than doubled in the last week. Is it not too late to get in there?
Well, it's obviously a trading vehicle. It's probably a huge short down the road, but the president has been predictable in his attempts to try to make it sound like he's doing something in this industry. I think he can bamboozle enough people, buyers, into coming in and buying these stocks. But you're going to have to flip them between 9:30 and 9:40 tomorrow.
Right, you wrote that. Other than Hoku, forget it. Sell the ethanol, sell the solar.
I think Hoku's a really interesting short squeeze. And when you have a really interesting short squeeze like that, it can go on for some time. And because the Sanyo contract's a real contract. I don't know what's gotten into that company. Right. But I think you have to look at these things as you have a very small float. You have 12 million shares being bought. You want to, if you were short it, you really have to cover because the pain's going to be immense.
It's going to be hard to find that stock, I would imagine.
Exactly.
Right. All right, Jim, thanks very much.
Thank you.
I'm Aaron Task. Stay tuned for more of TheStreet.com TV.
Welcome to Wall Street Confidential. I'm George Moriarty here with Jim Cramer. Jim, how you doing?
All right.
Rough day yesterday.
Right.
Very interesting though. We're up a little bit today, and nobody's coming out. Certainly, you haven't come out and said the bottom's here.
No, and I like to think of bottoms as staged. I've always found that they drop in stages and come back in stages, and there's 1/3 of a market usually bottoms first, then another third. But I don't say that that's what happens when we start selling off. It's what happens when we're done selling off, and I may miss the bottom of a sell-off. But my methods are uniquely involved to try to minimize downside, not to catch upside. Upside takes care of itself. Now, I've been looking at certain stocks that are keying off of National Semi and Texas Instruments, New York Stock Exchange. New York Stock Exchange because it's a really hated stock. I'm looking at that because there's a piece of news out there that's very positive, which is that Daily Deal is saying that the Justice Department is going to block CME CBOT unless they get rid of clearing, which is what the New York Stock Exchange really wants, is clearing. And the fact that that stock isn't bottoming on that piece of news after a big analyst day is telling me, be careful of these, of the financials, of the brokers, of anything in that ilk. And that's the group that needs to bottom first. Forget what will bottom first, but the financial and financial derivatives need to bottom first because they're trading off the 10-year, and it's the 10-year that's causing the sell-off. Each sell-off is different. The sell-off in February was a Chinese sell-off.
Right.
That's very different from a sell-off that's involved with the 10-year. So because each sell-off has a different coloration, you can't just say, okay, 1/3 is going to be ATT and Kellogg. And you can't do that. People want me to do that. I can see that in StockPicker. They want me to do that. Right. And I don't play that way. I'm not looking for a way to call a bottom. I'll call a bottom if I see it.
Now, sticking to the NYX corollary, because I think that's a good example. Right. Give them a concrete example. Where are we? So it didn't bottom here. We've had a sell-off for some time now. If it's still selling off
until
today,
I see a lot of put buying, whether it be at 60 or 70.
So that's a
A lot
strike.
of put buying underneath. Yeah, that causes me to sit up and take notice. That hasn't happened yet. There's still too much hope. There still need to be more people selling it. Maybe it needs to get to a 15 multiple instead of 25. I am very sanguine about stocks. I find that since I started the Street.com, it's really impossible to stay sanguine because there's so many cat callers and name callers when you get something wrong. And that's not, you have to tune that out. And now what I like to do is say, okay, listen, bet against me.
Right.
I'm not going to sit here and argue my case over and over again. Just bet against me. You think I'm wrong? Please buy puts, short it. Don't ask me to convince you because, I mean, I've been around. And life is not about convincing people to your viewpoint. Life is about saying, you believe in your point, I believe in my point. I'm not trying to compromise. If I compromise, that means I sell Bausch & Lomb at 47. I compromise, that means I sell Alcan at 43. Because what I'm doing is listening to people who know less than I do and have less conviction than I do, but love to throw stones. And, you know, that's very personal. I do a lot of stuff. It's Wall Street Confidential. I do things very personal. But I don't want to argue my case anymore after my preliminary case.
Right.
It's incumbent upon others to tell me why they think they should short it. But I'm not going to respond to should I short it.
To the national semi point that you made earlier, why is it that's leading the S&P? You say?
Yeah, Nat Semi's leading the S&P, and I don't want that because Nat Semi. See, we learned from analog devices that Nat Semi is zero sum with analog. So it's entirely possible the strength that Nat Semi has is another company's weakness. It's not the rising tide that I want to see. The only stocks that I care to really own in tech right now are my new four horsemen, Research in Motion, Amazon, which is the most controversial of those. I want people to own Google and I want them to own Apple.
Fantastic.
Now, and just we know on Apple, because again, there's a lot of confusion. Why is there confusion about the things that I do here? And the confusion is that I'm a professional. It's not that I don't know what I'm doing. It's I'm a professional. And a professional knows that if you have a pattern and the pattern keeps happening, an event occurs and the stock sells off. So you have to say, okay, listen, last time I got to the event, I'm going to be smarter than the average bear. And I'm going to sell it as it gets to the event and then prepare to buy it. It is not a judgment on the company. People always want to make the company be the stock. That's a major mistake that professionals never make.
And they miss the context, which is, I think, an important part of all of this, is looking at where we are in the broad market, in the particular stock, wherever you are. Don't focus on 1 minute. Focus on the large picture, where you are in the stage of a sell-off.
Right. I mean, what I would hope people would do, but I have been unsuccessful in doing this in the vast majority of the time that I've worked here, and worked here for 10 years, is to be able to convince people that I am not the anomaly. I am the way professionals trade. I was schooled by professionals. I was taught by professionals, and this is the way professionals trade. And why you don't know that is because no one else is going to be fool enough to tell people. But I do not look at Apple and say, do I like Apple or not? Product's great. I love Apple. You know, big deal. I look at the piece of paper, and the piece of paper has gone down after we've had big announcements. So I can't bet that this time will be different because that's not what a professional does.
Right. There you go. That's Wall Street Confidential. That's the way professionals invest. Stay tuned for more from the Street.com TV.